Thanks for tuning into Worldview. It's a show where we get some of the topmost global minds who think about investing to try and tell us how is it that they view the world of investing into risk assets from their prism for not the very near term, but maybe the slightly medium and the longer term. We, of course, try and invoke the near-term questions as well, and that is what we will do today with Xavier Baraton. He joins us right now on the show. He's the Global Head of Investments at HSBC. Xavier, great having you. Thanks for taking the time out.
Likewise, very glad to be with you today.
Thank you so much. Xavier, I was reading your note, and I would love to understand, for you to explain to our viewers as well, how do you think about the world economy and markets as they stand today as we end the first half of the current year?
It's been a tough year for many investors because it is a conflict possibly between the performance of markets, which has taken a lot of investors by surprise to a certain extent, particularly when looking at US stocks. Partly because many of us had relatively low expectations at the turn of the year. We were all expecting a recession, which is yet to materialize quite obviously. And as a result, the S&P 500, just to take this example, has performed relatively well. Now the optics are potentially a bit misleading because, as you know very well, the AI effect, the AI narrative has been the one common driver for performance of the US market in particular. There's a concentration effect and a contribution of AI-related stocks, which is outstanding. It represents more than 2/3 of the rise. And if we compare the S&P 500 XAI with the S&P 500, we get a relatively different story. So it's a complex markets to read, partly also because the fundamentals are now showing a disconnect with this stock performance, notably with the resilience of inflation, particularly on services, leading the Federal Reserve to be on the lookout for potential some more hikes. We expect another one in July, and Powell maintaining, like he did recently in Sintra in a conference earlier this week, maintain a hawkish tone in order to finally curb the unemployment and finally curb the inflation that's largely coming from services at the moment, really. So we could see further deterioration of the economic outlook, particularly in the US in the second half of the year. And finally, as we start to see gradually some of the financial metrics for corporate America to turn into negative territories. We have already the ratio of downgrade to upgrades, for instance, in the credit space, that's already turning below 1. We start to see downward revisions of the 2024 earnings per share, indicating that the market could start to plateau and finally reprice. Should the Fed persistence lead to finally the economic slowdown that many of us are expecting, really. So again, the contrast, and that's what we call in our semi-annual economic and market outlook, the out of sync between fundamentals and markets, out of sync also between developed markets and emerging markets, and I'm sure we'll come to that because that can be a way to protect portfolios at this juncture.
Yeah, most certainly. That will be of keen interest. But just before that, Xavier, folks who are in the US currently swear by the consumption going along, inflation going along. You reckon that because of these inflationary pressures and higher hikes subsequently, we eventually tailwind into a recessionary scenario in the US? And would that be bad for risk assets?
Eventually, it will affect risk assets for sure. I think what we've seen so far this year is still the tailwind of a few factors. Firstly, the robustness of the job market, which has been spectacular in the US and in Europe largely. Secondly, US consumers, households continue to benefit from the excess savings of the post-COVID era, but we know that this is coming to an end in the turn of Q4 later this year. The whole excess saving galore will be exhausted to a large extent. We also expect much more balance sheet contraction by the Federal Reserve and the ECB. Again, they had reflated their balance sheets in Q1, facing the Silicon Valley and regional banks turmoil, but now they've turned negative again. And we know that there's a strong correlation between the S&P 500 and the liquidity fueling markets as we've seen so far this year, really. So all this will turn to a slightly negative tone with consumption that could start to be eroded, and finally affecting the job market, services, which may converge towards the manufacturing, which, as you know, has been globally in relatively bad shape so far this year, really. So this will weigh on spreads. This will weigh on multiples, which start to see relatively stretched valuations, and that's the point of vulnerability for markets, as well as this turning technicals and liquidity being a lot less abundant in the second half of the year.
Okay, so if at the start of the year we moved from TINA, which is there is no alternative to equities, to a term coined by an Indian fund manager, TARA, which is there are reasonable alternatives. Now that we finished half, or we're done with half of the year, what's your sense about the second half? Do equities still present the best bang for the buck chosen wisely? Or do you reckon fixed income is as much out there, despite the point that you made about the possibility of further hikes?
I think we would definitely recommend investors to shift away from developed market equity markets, in the sense that as I said, we see valuations being a little stretched, the technicals turning less favorable, and valuations being no longer the sort of tailwind. Finally, markets will reconnect with fundamentals, which have been steadily deteriorating, really. So what does it mean for investors? How to relocate or reallocate? Bond markets are definitely a good alternative because in such an instance, and eventually if the US face a couple of quarters of mild recession, as we expect, that's our scenario, we will see the Fed not only pausing, because they will have obtained the economic slowdown and the slowdown of the job market, so they will cut rates eventually. So that's supportive for bond valuations. It will offset the spread widening that would necessarily happen with the deterioration of credit quality, and as a result, we will want investors to allocate more to investment grade, quality or high yield. So stick to the upper end of the credit spectrum. We think that we are also in a context where correlations between equity and bonds will not be performing as well as in the past. Last year was a real challenge with correlations turning very positive. Now correlations have gone back towards zero, but it's still a sort of a lingering problem for portfolio construction. And as a result, I think investors should be looking into diversifying a bit more proactively with more idiosyncratic stories in emerging countries in particular. Not just look at emerging countries as a whole, going into the classic indices, but looking at certain countries. India is a good example of such structural allocations. Looking at local debt, looking at emerging market debt more generally. Reason is we'll come to that, the fact that we see a weakening trend for the US dollar in particular, and a much better policy mix for emerging countries across the board. So finally, CARA is a great acronym, and it means we need to look at alternatives, and alternatives in the sense of private assets in particular. We think that they are a good way to diversify and compress volatility in portfolios as well. Should we face more downside in stock markets?
Well, viewers, so the line in the report that Xavier had and team wrote is that complex divergent economics creates unsynchronized markets, and that this environment means that there are new opportunities for diversification and relative outperformance. I think you just heard the explanation of maybe that line in the previous answer. Now, Xavier, I would love to understand just before I come to India, because that's where my principal interest lies. When you talk about the possibility of EM outperformance, are you thinking about weeks? Are you thinking about months? Are you thinking about quarters? Or do you reckon this is a long-term trend that has gotten unleashed?
We believe it is a long-term trend, and as a result, a pattern or characteristics that investors should be building as a strategic allocation in their portfolios. The reason is the fact that we are coming out of a long period, almost decade-long period of US exceptionalism to a large extent. It was fueled by abundant liquidity, the negative rates or zero rates policies by the Federal Reserve, and a lot of quantitative easing, as you know very well. Some transformation and a lot of social transfers as well during COVID, which has added to this spectacular mix for the US, when a lot of countries around the world were struggling with the creeping up geopolitical concerns or greater volatility on commodities, for instance. So we've had a decade long of outperformance of US stocks versus the rest of the world, and we believe that this is about to turn, really. Firstly, because the Fed will maintain a hawkish bias generally, in the sense that inflation for us, leaving behind the current tactical situation, will remain elevated. What we saw before, the 2% as a ceiling for the Federal Reserve, is now probably a floor when we look at the core CPI. So other factors come into play, as you know, geopolitics, the net zero trajectory, the fact that supply chains are constantly a little bit under pressure. We call this regime spikeflation, and as a result, the Fed will constantly maintaining a tightening bias, and which will compress a little bit the US economy. It will, by contrast, particularly if the Fed eventually face a recession and have to cut rates, affect the US dollar. And by contrast, we see in emerging countries, as I was mentioning, a better policy mix probably coming into play with lower inflation. India is a good example, but Brazil, China, Mexico are no longer facing inflationary challenges. The inflation has already curbed, and these central banks, the central banks of these countries, have probably an opportunity to cut rates earlier than the Fed itself, really. So from that perspective, we think that economic growth could continue to be well sustained in emerging countries, and opening a period of outperformance of emerging market stocks, which are also supported by relatively attractive valuations when compared to developed countries, really.
Got it. Okay. Now, you were on record. I read a comment on Bloomberg. And I'm not saying verbatim, but you had on record saying that India is unavoidable when it comes to investing, or India is unmissable when it comes to investing. Now, I would love to understand, how does a large global advisor / money manager think about India currently, in light of the fact that geopolitically very favorably placed, growth-wise very favorably placed, but a refrain that we constantly hear from people is that the near-term investability is an issue because of the valuations. How do you think about this?
Well, we think that there are two aspects. Firstly, the opportunity that India represents as a structural allocation over the long term, the next decade, is still underappreciated because I think to a certain extent, and it's a bit of a classic of how investors in developed countries may consider emerging countries, a lot of cyclical volatility and not always the structural improvement that you expect to see over time, really. And I think many investors underappreciate the transformation that India is going through in terms of structural reforms. We can talk about bankruptcy laws, we can talk about digitalization, infrastructure, the very visible improvement in the banking industry are such examples, really, and leading to a virtuous circle, which is not debt fueled as it can be sometimes the case for emerging countries, leading to this boom and burst cycle, which has been the curse, particularly of some of the frontier countries. India is very different, and at the moment in time, it's really accelerating on a non-debt inflated mechanism. And for us, given the size of the country, it's indeed unavoidable and underrepresented in portfolios, in indices as well, really. And that's the message we are giving to investors. Now, to your point, what about valuations? Optically, yes, at this point in time, a PE at around 20 times could look expensive particularly when looking at other emerging countries. Now, again, a few things to put into consideration. The first one is that India has always been a bit more expensive than other emerging countries. Just need to appreciate that. Secondly, I think there is still the potential for this policy mix and the fact that over time, India has a good chance to no longer pay this inflation premium, getting to real rates that the equilibrium should be around 1%. A PE of 20 means a yield around 5 and then a 4% equity premium versus this 1% real rates, if you will, which we consider is not particularly shocking, is not particularly expensive, really. Again, we see the financial flows, we see the major country or national statistics equilibriums being relatively well behaved, and economic growth we expect over the coming decade will be one of the highest across emerging countries, and will surpass China as an example, which again is yet to be fully appreciated by investors as a theme that is not just trendy and that could be affected by an entry point, but it could represent or should represent a structural allocation which is higher than what investors have in both bonds, by the way, as well as in equity for Indian assets.
Do you foresee a point wherein a large India dedicated flows become a norm? Because we see idiosyncratic instances of the same. Otherwise, it's more an ETF or an EM allocation that happens to India. But as India's share in world exports, in world market cap, so on and so forth, keeps on going up, when does that move happen? I mean, it happens very selectively. When does it happen, let's say, en masse?
I think it's the process is underway from a perspective. I've been traveling quite intensively over the second quarter of this year, meeting investors in Asia, in Europe, private banking as well as institutional clients, and all of them recognize the opportunity of the Indian story. Okay. It's like you pointed out very rightly, the valuations can affect how forcefully investors will allocate to equity vis-a-vis bonds, which maybe at this instance possibly a bit more attractive. But they all recognize that the Indian story could be not only the structural allocation they need to add, but also a solution to some of their portfolio construction challenges they're facing. Because as I was mentioning, last year was disastrous for the so-called the proverbial 60-40 equity bond portfolios, because the correlation was very positive, and it was a very negative experience in terms of returns for investors. Now, India is very decorrelated. It's totally out of sync with the developed markets in particular, or US dollar assets. And as a result, it's a way to diversify your way and bring stability to your portfolio, as well as capturing a relatively attractive yield in the current environment, with a sort of a country macroeconomic diagnosis, which ticks a lot of boxes. And with these financial flows that could continue to be a tailwind, really. So the mass market is for us is a story that's unfolding at the moment quite clearly. It's very much all the conversations I've had with high net worth networks, for instance. But institutional clients are also starting to consider allocating to India separately. And it's important in the context of the Asian allocation, which many clients are now considering in a sort of a more country by country, partly because of their sentiment vis-à-vis China. India is therefore a way to counterbalance and maintain your Asian exposure without adding to China necessarily.
Got it. And of course, I'm guessing in some fashion the depth of the Indian markets, which saw the FIs exit at such a large way without too much damage to the ticker, probably also may have played a part in people looking at it more favorably. I think we saw serious amount of outflows from FIs over the last, let's say, until March of this year, and the exits happen at a good pace. So I was just wondering if that also helps.
Yeah, I think the technicals more generally are quite clean and healthy. I think of course the idiosyncratic corporate stories can come into it, but the response was finally relatively good, really. And the discussions I've had so far over these past few weeks was certainly not affecting the confidence of international investors. Right. They see, as well as you see in India, the interest of large international corporations, which are increasingly investing in India, manufacturing in India. Apple is a good example, but we could name quite a lot of companies in the consumer goods and or in the energy sector. And I think it's this mark of confidence is a very strong tailwind for several years, quite clearly.
Xavier, before we let you go, we've taken a lot of your time already, but one last question. What are the risks to this story? Could it be an election risk in 2024? Could it be something else? Is there a large risk to this quote unquote fanfare around India currently?
For financial markets more generally, there are always a good deal of risk going on. It could be the US election and a return of Trumpism, which would be potentially affecting global markets and global stability to a certain extent. It could be Russia, which is relatively volatile now on the domestic scene, as you've seen over these recent days. I think the number one risk for us globally is the risk of more sinister recession in the US. What we expect is a mild recession, more like in the early 90s, typically. But if the Fed was to persist even more with their credit tightening and the transmission wheels through the banking system aggravating this trend, we could see a negative spiral emerging. It's a very minority and secondary scenario for us, but it could still happen nonetheless. So that could affect emerging markets generally by increasing significantly the overall global risk aversion. In a way, if we take the US dollar as the transmission wheel, there's usually a sort of a smile for the US dollar. When the US economy grows much more than the rest of the world, the US dollar will perform. At the opposite end, if the US economic growth plummets significantly, risk aversion picks up, and it's good for the US dollar as a safe haven, and that could affect several countries. But again, I think India shows a relatively low correlation and is more sort of an organic story as opposed to being extremely dependent from international flows, FDIs, or global trades. Really, of course, tailwind is tailwind, but we think it could prove actually quite a good allocation as part of a slightly more defensive play.
Xavier, this was a pleasure. Thank you so much for your time and your insights. Lovely talking to you, and I look forward to talking to you again.
Absolutely. Very happy, and hopefully in person at some point in time in India. Thanks very much.
Cross fingers for that. And viewers, thanks for tuning into this very special episode of Worldview.